Hey, Renee, how are you doing today?
Hey, Amy, I'm doing great. How are you?
Doing good. So you feeling better? I know you was under the weather last week and we didn't get to have our Friday.
Yes, ma'am. Much better. Back at it.
Okay, great. So we're going to jump into this Fun Fact Friday with lots of fun stuff we're going to break down a credit score. You know, what makes up your credit score, do's and don'ts, the explanation of the different credit bureaus, what the lender's looking for, all that kind of good stuff for getting a mortgage to buy a house. You know, even if you already own a house, you're not going to buy another one, you're going to need to get a pre-approval. So the credit score is still important in that aspect as well, not just for first-time home buyers, right?
Right. That's exactly right.
Okay, so let's see. We're going to start with what is a credit score exactly?
Your credit scores are made up of, any open account that you have that you make a minimum monthly payment on, or you make an installment payment on.
Mm-hmm.
It's important to have a little bit of both if you can, like maybe 2 revolving accounts, but also try to have an installment because that's
Mm-hmm.
where you're going to maximize your credit scores if you use them correctly. But
Mm-hmm.
they look at how long you've had credit, how long your credit has been good. It's a very fine line as having not enough and too much. You have to find that balance.
Mm-hmm.
Um, say for example, you open a credit card with a $3,000 limit. Well, if you go charge it up to $2,500, you're going to have a big hit to your credit because you've almost maxed it out. So on a credit card, it's very important, yes, that you try to keep your balance, try to keep it at 30% or less of the limit.
Mm-hmm.
Because from a credit scoring standpoint, the way they look at it is if you're having to use it like that and you're maxing it, then
Mm-hmm.
you're having you're struggling somewhere. May not be the case, but when they're scoring you, that is a very big deal because it makes it look like you are having to use that to live or something like that. So it starts taking points away. The higher you get or the closer to your limit,
Mm-hmm.
the more it starts deducting your points.
And just for clarification, what's the difference between a revolving account and installment accounts?
Okay, so your revolving accounts are your credit cards where your minimum payment can change based on your balance. An installment is, say you go to the bank and you get a 12-month loan, and you have a set payment the entire time until it's paid off. That payment won't change. That's an installment.
Gotcha.
So that's
Gotcha.
the difference between the two.
Very good. And there's three major credit bureaus. And so one of the questions that I get a lot of times when I'm talking to people is, which credit bureau is the lender going to look at?
Very good question. When we pull credit, we pull all three. We pull Equifax, Experian, and TransUnion. Okay. We don't use any particular credit bureau. We have to use the middle score in number order. So we take the three and whatever's the middle in number order, that's what lenders have to use.
So you drop the highest and the lowest, and you take the one that's the middle, whether
Yep.
that's TransUnion or whether that's Experian or Equifax.
Correct.
And not all companies, not all businesses report to all three bureaus. So that could be one reason why your credit scores will be different.
That's exactly why your credit scores are different. Usually if someone has issues, I will look at their report and usually I can say, well, here's why this one is so much lower because you only have one line of credit that has reported to that bureau. And I'll show them where it tells you which bureaus report that account and explain that that's how your score differs with each different bureau. But yeah, that's exactly right. That's part of it.
I think we already talked about this a little bit, but about what determines the credit score. So you've got the type, the payment history, the length, the credit limit, and the what would you call it? The debt, not debt to income, the
amount you owe in comparison.
Yes. I can do it out. Yeah.
Yes, that is exactly right. And current 30-day lates are a huge factor. They drop your score drastically, instantly. So that's a big no-no if you can help it. If it's 5 or 10 days, that's different, but they report after 30 days late. And as soon as you see a 30-day late hit, you're going to see your credit score drop pretty drastically.
Yes, I know. That happened to me about 2 or 3 years ago. I would monitor my credit score through I have a Citi card. And, when you log into a lot of these different credit cards, you can see a certain FICO score or whatever. We'll get into that. And my score dropped 100 points.
Yeah.
I had a heart attack. Because I knew I wasn't late on anything. I've got everything set up on auto payments. I was like, how did my score drop 100 points? So I went to the annual credit reports website and pulled all 3. And I found on there a medical collection that I'd never received. And I found out the facility was sending it to just my street name. Didn't even have the mailbox number on there. So I never got it. But anyway, I paid it, and it took about a month or month and a half, and it was removed, and my score jumped back up to where it should be.
Right. I gotcha. Yeah. It takes a minute, but it'll come back up. But after you truly have a 30-day late, it takes timely payments for probably 3 or 4 or 5 months to make up for that one 30-day late payment as much as it drops it. So if you can help it any way at all, do not have any 30-day lates.
Yes, definitely try to pay your bills on time. And so the next question is the fun one that you get, I get, is,
oh yeah,
why does my lender say my credit score is less than what Credit Karma or Login and Experian or any of these other ones say?
Right. That's a very good question. And yes, we do get it every day as well. The reason is if you research it like on Google, you'll see that Credit Karma and the other credit monitoring service pulls what's called your Vantix credit scores. Okay. That's the model in which they score. Well, we pull FICO, true FICO scores. And that's why they're different. We usually see anywhere from 20 to 40 points difference. Credit Karma will be 20 to 40 points higher than what we will see as a lender when we pull FICO. There are a few occasions where we pull and it's the same or sometimes better, but it's rare. But yeah, until you know your true FICO scores, it's just hard to tell. But still, it's still good to monitor, because when you see it jumping on there, it's jumping with us too, just maybe not at the same rate, but it's moving, it's going in the right direction or the wrong direction. But but at least when you're monitoring it, if someone commits fraud and opens an account in your name, there's a lot of pluses to it. Just don't count on their scores to be the same when you go to have a hard pull, credit report for buying a home, because it's very rare that it's the same.
Yeah, and like my example, just using those just to monitor to see what was going on, I wouldn't have known that I had something go to collections that wasn't in that 100 point.
Yep, that's exactly right. So it is very good service. It really is. It's just not the same on the scores.
Exactly. I usually tell people expect it to be at least 20 points less.
Oh, for sure. Yeah, at least. Yeah. That's 20 to 40 is pretty accurate most of the time.
Okay, so what about if you've never had credit before and you need to establish credit? We've got seniors graduating high school this week, next week, about to enter their adult life. If you had advice to give them on getting ready for their future, of course, I know they're not going to run out and buy a house tomorrow, but you got to be future thinking. So what should they be doing? What should their parents be advising them to do to establish credit, to establish good financial, what I'm trying to say?
I do. I get it. Well, if at all possible, I think it's a good thing for a parent to not just put their student as an authorized user, because that everybody's kind of caught up to that, and it just doesn't work that well anymore. But if a parent could get a credit card, just a small one, and be a co-signer with their student on it. And that way the parent can kind of monitor it too, and, make sure the student's doing what they need to do and teaching them and showing them how to handle those kind of things, because they don't know.
Right.
So I think that's a great opportunity. And again, it gives the parents, the option to, they can monitor and they know when it's paid. They know if it's late. That way, if they had to, they could pay it. But just to help them create those habits of getting used to paying those monthly credit card bills. And then the next thing would be, more than likely, you're going to need a little money, probably $300 to $500, but you want to either go to your bank or your credit union, or even I think Capital One does them, but you can open a secured credit card. Mm-hmm. And basically all that is you're giving them $500 and they're putting it on a credit card. So you're really using your own money, but they report it to the credit bureau.
So it's kind of like a prepaid card.
It is. It's same thing. So it reports just like a credit card, but it's secure because, they have no risk because they already have your money. So, but they report to the credit bureaus for you, which in turn helps you start building scores and, getting into position where in time you can open maybe an installment loan or something else on your own to build it and try to get, you have to find that balance, like I said, but it's best to start with 2 revolving, get used to paying those timely, that kind of thing. And then if at all possible, get an installment, because those do in time help to build your credit score, and kind of stabilize it. So your goal should be to have at least 3 open lines of credit with a 12-month pay history to maximize your credit scores. I'm not saying you won't have higher ones before that, but when you've had an account for 12 months and you've paid timely for 12 months, that's when you get your big bumps.
That's so that you're being, that
because it shows consistency and you've got a year's time. Yes, that's exactly right.
And if they go and get an installment loan, or just like with buying a house or refinancing, your credit score will take a temporary dip, right?
Correct. Usually, most of the time, especially when you're starting and you don't have a lot of good credit to offset that, it will drop when you have your credit pulled and when it's reported. But after you make a couple of timely payments, it'll pop your score back up there.
Right. So you just gotta kind of ride the waves and look at the long term as far as getting established in, establishing a credit history to get ready to buy a house one day in the future.
Right.
And now I have heard about, that when kids start college, there's going to be a lot of credit card offers and things like that. So don't go crazy either.
It's amazing, but yes, they will give you. Yes, my daughter did the very same thing, and she said, "Look, I got this card, and I went and bought this stuff, and they just gave it to me." No, they didn't. They did. But you still have to repay it and you don't have a job. So, so that was an opportunity for me to teach her, and it freaked her out. So she paid it off and she closed it and never used it again. Because that was her first card, and she just really wasn't exactly sure how it worked at that time. And when I told her, she did not like that. So, but yes, they will be coming at them right and left with credit card offers. And believe it or not, they're going to, if you put on there, you make, I don't know, $200 a week. You don't have to prove it. Most of the time, they're going to use that and give you credit cards, which is, absurd, but they do. And it's just, you've just got to be knowledgeable and know that there is such a thing as having too much credit. Even if it's all good, once you have more than what they consider a good amount, then that can start, dropping your scores. So you need to build it slowly and monitor it, and just have to find that balance, that fine line to keep your scores stable and good, which again should really be about 2 small credit cards, and then 1 installment loan. And like I said, once you've had all 3 of those for 1 year and it shows 12 timely payments on all 3, that's when you're going to see a good bump in your score. And as long as you keep that, it's going to stabilize, and your scores should be pretty good as long as you don't have a lot of inquiries, have any 30-day lates, that type of thing.
So let's say when even like I go shopping, I go to a department store and I check out and they ask me, "Oh, are you going to pay with your such and such card today?" No. Would you like to apply for one and get 10% off? There's a type of card. You know, I mean, some people, they do have several. You got Kohl's, JCPenney, Dillard's, several cards, department store cards. So that's what you're talking about, where you could get into having too much, right?
You can. And, you know, in fact, I had someone like this the other day, and it was all right before Christmas. So I knew that's exactly what it was. But basically, they opened them up, got the discount, and closed them.
Mm-hmm.
But they had an established credit history. So
Mm-hmm.
it didn't really, they had a good established credit history. So it really didn't hurt them. But if you're just starting out and you only have one or two things, and all of a sudden there's an increase in the amount of inquiries and the amount of accounts you're opening,
Mm-hmm.
and you open a lot of accounts at one time, that will definitely tank your score for a little bit until they can make sure you're going to make those timely payments and have a timely pay history to offset all those inquiries and that open credit that you've established.
Because y'all see the inquiries.
Oh, yes, ma'am. We have to, when we close a loan, we have a form with all inquiries all the inquiries in a year. And we have to list those, and the borrower has to put, you know, what it was for, did they open new credit,
Mm-hmm.
et cetera, kind of thing on every single inquiry.
Yes, I remember when we refinanced, we had to sign one because we had rate shop before and had to sign that, you know, that was just for rate shopping, and we were not buying another house, basically.
Right. And that, you know, lenders have to know that you haven't went out and opened up more credit while you're in the process of a mortgage that may not be on your credit report, that we have to count as a debt. And that's why, like, a few days before closing, we have to do a soft pull on your credit to see if you've opened new debt. And if you have, we have to count those as debts against you. And it could very well cause issues with debt to income ratios.
Oh, yeah.
We
Furniture.
do have that happen. Cars. Yeah. You know, people don't realize that it's pulled again before closing to verify they haven't opened new debt. And we do try so hard to tell everybody that. We give a little piece of paper that, you know, tells the do's and don'ts. Don't have any inquiries. Don't open any new credit, you know, but it still happens. And a lot of the times we're able to work it out, but it has caused a few deals to crash because of debt to income ratios. So
yeah, even those 90-day payments cash or no payment 6 months, you know, furniture type loans especially, they're still pulling your credit then, right?
Oh, yes, they do. They do. And even if they don't pull your credit, like, for example, those, I can't think of the name, but like Money Lion or Money King or some of those where they actually don't pull your credit. But we can see in your bank account where they deposit money into it and you pay them back. And when we get bank accounts, if that's on there, we have to find out about that. If you still owe them, we have to count it as a debt.
Oh, wow.
But we've seen a lot of that lately, and they do not pull your credit. So there will be no inquiry. If we see those payments being made through your credit report, through your bank statement, the underwriter's going to want proof that it's paid off or how much is owed, and we have to count that payment as a debt against you that we didn't know you had originally.
So the consumer may think, or may even be misled to think that this isn't going to hurt my credit, but y'all still going to see it because you get copies of all the bank statements.
Yes, ma'am.
And we have to account for all of
That's exactly right. And we're seeing a lot more people use that, those programs. I think on one particular one this week, you pay X amount up front, and then you establish kind of a line of credit that, like, if you need $100, they'll automatically deposit it into your account, kind of thing. And I'm seeing it more and more, actually twice in the last 2 weeks. So, yes. And the customers don't realize that. They don't think of it as a line of credit because their credit wasn't pulled and it's not on their credit report. So they weren't really trying to intentionally keep anything from us. They just didn't know. They didn't realize that. But it worked out. We got proof they were paid off, and everything was good in those instances. But had they not been paid off, you know, then that could bring in some issues.
Yes, definitely. Learn something new every day. I had not heard of that.
It's becoming a lot more popular.
Well, to wrap things up, I was teasing you earlier with our bonus question. What if I follow a certain financial guru's advice of having a 0 or indeterminate credit score? How do I still buy a house? Name names, but we probably all know who we're talking about.
Yes, we do. I don't recommend it because it's a very difficult, in detail, thorough, underwritten file. We have to, first off, you have to have a rental history to do that loan, because that's the main thing. They've got to see that you've been paying rent, you've never had a late payment. We have to document that with canceled checks. Like, we have to prove every bit of that. Then we have to show 3 open lines of credit, such as utilities, cell phone, car insurance, but we have to have 12 months pay histories from all these places that are broken down to show you never had a late payment or a late fee. They're gonna require money down. You will not be able to get a gift. You have to have your own funds. They want you to have some skin in the game. And if you don't have credit, it's so much of a higher risk that they're going to make you pay money down, closing costs, etc. And they're not going to allow it to be a gift, because that's not technically your money. Somebody's given that money to you. So you have it saved up and invested in that. So it's not easy. I'm not going to say it can't be done. I've done it before. I haven't done it in a while, because a lot of times the reason people don't have scores is because they've always just not opened credit. Some people keep their cash at home. They use that. Some people just don't believe in building credit. And that's fine until you're, wanting to buy a house or something else, and you need those credit scores. And there are so many things these days that those credit scores determine the cost and the rate and those type things. I just personally don't think you should not have credit. I mean, you should have credit. You should have credit, and you should have scores if at all possible, because it affects a lot of things, not just your mortgage, your car insurance, home. Everybody nowadays pulls credit for everything, that costs you money. And so if you've got decent scores, you're going to get better rates, but no scores automatically means a higher risk on everything. Even though it's a good concept to be debt-free on paper, it still hurts you in the long run, in my opinion. That's just me.
So if somebody did try to go through that underwriting process, would they provide all that, or would you have to get that from the utility, from each utility?
No, they have to do all that. They have to get everything.
They have to
do contact their utility company, cell phone, and those companies will give these things. I used to do a lot of these back a long time ago, when it wasn't quite so hard to do. But yes, we just have the buyers, contact the companies and ask for those. And all companies pretty much have them. We've never really had a problem getting them. But a lot of people may not even have that. Younger people, they may be on their parents' car insurance plan, on their parents' cell phone plan.
Right.
They don't have anything that they pay because their parents pay utilities. So it's not always a perfect, it just is not always a good answer to it, because there's so many factors or layered risk factors we have to take into consideration. You just have to kind of fit in that certain box as to whether or not you can even attempt it. So.
What about that? What's it called? Experian Boost. I've actually done this, but where you can link your bank account and it will boost your score by looking to see, I think like Netflix or different utilities, and it bump it 10 points.
Right now, I have seen where people will do utilities is mostly what we see. And that helps people get started and established credit, so that maybe like a credit card company will give them a little $300 credit card also too. And that is a good thing. That's a good thing to get started with. But again, a lot of your younger people don't have that because they don't pay utilities. They're on all their parents' plans. So for them, it's really not going to help them get started in that aspect unless they do have utilities in their name and they actually pay them, kind of thing. But yes, we do have buyers that are starting over, maybe have had a bankruptcy. They're trying to rebuild credit. That's an excellent thing to do. And the good thing about it, it does start building your credit and get you scores and helps to start you, building that. But when it comes time to qualify you for a home, we don't use those payments as debt.
Gotcha.
So we only use your, credit cards, installment loans, student loan payments, car payments. We don't count those utility payments, even though they're on your credit report.
And that's the great thing about working with a lender such as you, Renee, is if someone is not ready to buy right now, but they know they need to establish credit or need to get their credit to where it needs to be, you're willing to work with them to make a long-term plan so that 6 months, 12 months, maybe even 2 years from now, they'll be ready to buy that first home.
Yes, that's exactly right, Amy. I do that quite a lot, actually. We can do a soft pull on customers' credits. And then we have a report we can pull called a Wayfinder or a what if simulator that we pull through the company we pull our credit reports through. And it literally tells exactly what can be done based on their current credit to get their scores up and how much it'll get their scores up.
Isn't technology fantastic?
Yeah, and so usually what I'll do is if somebody calls and they either know they're not there or we pull their credit and they're not to where they need to be, first of all, I'll go over it with them, but I run those 2 reports and then I print the report, the Wayfinder report that gives them step by step what to do. I email them their credit report and the Wayfinder because it's very user friendly and it breaks it down exactly what needs to be done. I email that all to the client and say, go over all this. If you have any questions, call me back. If not, start doing these things, save your receipts, get me proof of all this. And if you have done all this in a month or 2 or 3 or whenever, if you can provide me those receipts and you're ready to buy other than that, I can do a rapid rescore that only takes about 5 to 7 business days based on those receipts, and it'll get your score to where it needs to be. Then we got you ready to buy. Or you can do it over time as you're saving up money, getting your scores where they need to be, so.
Well, Renee, you have been a wonderful source of information today, and I hope that those that have tuned in to watch this, or if you're watching the replay of this, it's very helpful. And if anybody has any questions about buying a house or whatever, feel free to reach out to me or Renee. Let me see if I can get our phone numbers back up here. Give me just a second. And we would be more than glad to help you out, get you started. There we go. There's our phone number.
Start now and prepare. If you've got patience and determination,
yes,
you can buy a house.
That's what I believe. I believe
it's done. You just have to, you've got to have the patience and the determination, and you've got the 2 people right here that'll help you get there. So,
yes, that's what we love to do.
That's right. That's right.
All right, Renee. Well, thank you so much for joining me again on Friday, and maybe we'll talk again soon. If anybody has any suggestions on what you would like to know more about, feel free to comment below or reach out to us, and we'll plan our future Fun Fact Fridays.
Awesome. Sounds good, Amy. Thank you for having me.
All right. Thank you, Renee. Take care.
You too.
Bye. Bye.